Welcome to the deep dive. We're here to break down the most critical reports and research, giving you the essential insights you absolutely need. Today, we're diving headfirst into a really pivotal special report. It just dropped August 12th, 2025, and it dissects the July 2025 Consumer Price Index, the CPI report everyone was waiting for. Now, on the surface, the data might look deceptively calm, maybe validating those hopes for a big monetary policy shift, maybe even some rate cuts coming soon. But as we dig into this analysis, we're going to find a much more complex and honestly kind of troubling picture. The report's main argument, and we'll unpack this carefully, is that the U.S. economy is now dealing with what it calls a two-track inflation environment. So track one, those headline numbers, they're moderating, and that's fueling a lot of the optimism we're seeing in the markets. But then there's track two. And this one's arguably more important. It's a noticeable uptick in the most persistent, the really stubborn parts of inflation. Our job today is to meticulously break down the official Bureau of Labor Statistics data, separating, as this report puts it, the headline noise from the core signal. This isn't just, another economic report. It feels like a key moment, this tale of two inflations. And we're going deep into what that really means for you. Understanding this is really paramount. It's your shortcut to being genuinely well-informed and, frankly, crucial for navigating what looks like it could be a pretty hazardous economic landscape ahead.
It really is fascinating, isn't it? How that initial calm in the headline numbers sort of hid the real story brewing underneath. If we just, look at the big picture for a second, the good news wasn't really about the whole economy cooling down broadly. It was much more specific and, well, fickle. So let's look at those top-line figures from the July CPI report. The all-item CPI for all urban consumers, that's the main CPIU number, it rose 0.2% month over month, seasonally adjusted, of course. That was actually a little slower than the 0.3% we saw in June, and it pretty much met what economists were expecting. And then year over year, headline inflation just held steady at 2.7%, same as the month before, and actually a bit cooler than the 2.8% people thought it might be. And that seemingly stable figure, well, it immediately triggered a positive market reaction. You could almost feel the collective sigh of relief. But, and this is the crucial point the report makes, the stability, well, it looks good on the surface, it's largely an illusion. It was driven almost entirely by a pretty significant but likely temporary drop in volatile energy prices.
The energy index specifically fell quite a bit month over month in July, about 1.1%. That reversed the gain it had in June. And it was led by gasoline prices dropping over 2%. Annually, energy prices were actually down 1.6%. So this sort of deflationary push from energy was strong enough to effectively mask the acceleration that was happening elsewhere in the stickier parts of the inflation basket. The report is really clear on this. Without that downward pressure from energy, the headline number would have been significantly hotter. It would have told a much more worrying story about underlying trends. For you listening, relying on something as notoriously volatile, as subject to geopolitical shocks as oil prices, to base your long-term view or investment strategy on, well, the report argues that's a critical error. The good news was essentially a lucky break at the gas pump, not a fundamental shift in where prices are heading overall. Hashtag from 1.2, the alarming acceleration of core CPI.
Yeah, that initial calm, it really starts to unravel pretty quickly when we shift focus to core CPI. That's the measure that strips out those volatile food and energy bits, right? To give us a clearer picture of the underlying trend. And the numbers here, they tell a very, very different story. Core CPI, that's all items less food and energy, it rose 0.3% month over month. Okay, so that's an acceleration from the 0.2% increase we saw back in June. But the real headline grabber, the number that really jumps out, is the year-over-year figure. Core CPI accelerated to 3.1%. That's a pretty notable jump from the 2.9% rate we had in June, and importantly, it was hotter than the 3.0% economists had penciled in. This 3.1% year-over-year core CPI, you could argue it's the single most important data point in this entire report, certainly for long-term thinking and definitely for the Federal Reserve.
Absolutely. This number signals that the whole disinflation process, the cooling off of prices, hasn't just stalled. It's actually showing real signs of reversing course. It directly challenges that narrative of, immaculate disinflation, that kind of hopeful idea that inflation would just glide smoothly back to the Fed's target without causing too much economic pain. Kathy Jones, chief fixed income strategist at Schwab, she put it pretty bluntly. The trend is heading in the wrong direction. And this isn't just some statistical blip. The report really emphasizes that this reflects genuine, broad-based, and persistent price pressures. These are coming mainly from the services sector, but also, and this is a newer element, from goods categories that are now starting to feel the impact of those new trade tariffs.
So what does this all mean then for the Fed's next move and maybe for your financial decisions?
Well, this 3.1% figure definitely moves the needle further away from the Federal Reserve's 2% target.
It significantly raises the bar for them to justify cutting interest rates anytime soon based purely on inflation data. It does as the core underlying inflationary forces are just proving much more stubborn, much stickier than many people were hoping.
Okay, let's dive even deeper now. There's this specific metric, it's not an official government number, but analysts calculate it, called supercore inflation. And the Federal Reserve, particularly Chair Jerome Powell, has repeatedly pointed to this as being extremely important for understanding inflation's path. So what is it exactly? It measures inflation in services, but it excludes energy services and also the housing component, which tends to lag quite a bit. Pell basically called this the most important category for figuring out where core inflation is headed because it's seen as a strong proxy for wage-sensitive, demand-driven domestic price pressures. It's supposed to give us a real sense of how much underlying demand within the U.S. economy is truly pushing prices up. So the big question, how did this crucial supercore measure do in July? Well, it surged. Analyst calculations, they vary slightly, but they put the month-over-month increase somewhere between 0.48% and 0.5%, almost half a percent in a single month. That's the biggest jump we've seen since January of this year and really one of the strongest readings all year. Just to put that in perspective, a monthly increase like that, if you annualize it, well, it translates to a rate of roughly 6%. And 6% inflation is fundamentally incompatible with the Fed's 2% overall target. It's a huge red flag waving right there.
Yeah, that sharp increase in supercore is definitely alarming. And it's alarming because the main drivers were pretty broad-based. It wasn't just one weird thing happening. It suggests really resilient underlying demand is still out there. So, for example, medical care services jumped 0.7%, and a big part of that was dental services surging 2.6% in the month. Even airline fares, which had actually been helping bring inflation down recently, they reversed sharply, rising 4.0% in July. And other service categories, like recreation services, they also chipped in with a solid 0.4% monthly increase. It's a pretty widespread. The report actually calls this spike in supercore inflation the smoking gun in the whole CPI release. And I think that's fair. It provides really clear evidence that the most persistent part of inflation, the part driven by domestic demand and wages, is actually reaccelerating. This is the component that's most closely linked to the labor market and wage growth. So its strength suggests these underlying inflationary pressures are becoming more entrenched, not less. And that obviously really complicates things for the Fed. It challenges the idea that they have plenty of room to start easing policy.
Right, so it raises that crucial question. If this key measure, the one the Fed watches so closely for domestic inflation and still running this hot, how much room do they really have to cut rates without just reigniting inflation? Puts them in a tricky spot.
A very tricky spot, yes.
Okay, let's unpack this even more then. If we look closely at the major categories within the CPI, it reveals this really complex mix of forces at play. And this isn't just about abstract numbers, right? It's about what you're actually seeing and feeling in your everyday life. At the grocery store, eating out, buying things for your home. So first up, shelter. Now, this is the biggest single piece of the CPI pie, and it was still the main reason the overall index went up in July. However, its momentum did keep slowing down, which was kind of expected. It rose just 0.2% month over month, matching the pace from June. Both owner's equivalent rent, OER, and rent of primary residence saw similar small increases, around 0.3%. Year over year, shelter was up 3.7%, which is still pretty high, obviously, but it is continuing to cool down from those peak levels we saw. And it's really important to remember, shelter data lags reality quite a bit. Okay, now let's talk food. The overall food index was basically flat, 0.0% month over month, but that flat number hides a pretty significant split. If you look at food at home, so grocery prices, that index actually ticked down slightly by 0.1%. We saw some price increases in things like dairy and meats, poultry, fish, eggs, but those were more than canceled out by declines in other food categories and non-alcoholic drinks. So yeah, you might actually be seeing a little bit of relief at the grocery checkout, although interestingly, egg prices fell nearly 4% in the month, but they're still up a staggering 16.4% over the year. Shows some of those persistent supply issues are still around. But then the other side of the coin, food away from home, restaurant prices, that continued its steady climb, rising 0.3% in July. That was driven by increases in both full-service meals and limited service, like fast food. Annually, the cost of dining out is up 3.9%, and that's a really clear reflection of those stubborn labor cost pressures in the service industry, which ties right back into that supercore story we were just talking about. Right, so maybe some relief at the grocery store, but eating out is still definitely hitting the wallet. Okay, finally, let's look at goods, but excluding food and energy. This area, according to the report, provided some of the first really concrete data-based evidence that those tariffs are starting to bite. New car prices were flat, but used car and truck prices rose 0.5% month over month. And maybe more telling, prices for household furnishings and operations went up 0.4%, and apparel prices also ticked up 0.1%. Now, numerous analysts and news reports were explicitly linking these specific price hikes to the tariffs on imported goods that went into effect earlier in the year. It really suggests that companies, which maybe had been swallowing those costs for a while, are now starting to pass them on to consumers. So that's potentially a new source of inflation pressure building up.
Yeah, this whole sectoral breakdown really does underscore the sheer complexity that policymakers are grappling with right now. It's not simple. On the one hand, you have the expected cooling from shelter finally starting to show up in the numbers, which is good. But then it's being counteracted by these new inflationary pushes from sticky components like services, and now possibly this new wave from tariffs starting to filter through. That split between grocery prices falling slightly and restaurant prices climbing really highlights how labor costs are keeping services inflation high, even if some commodity prices are easing, and at the same time, seeing prices rise in those tariff-sensitive goods categories. It signals that maybe a new wave of cost-push goods inflation is just beginning, exactly when services inflation is proving so hard to get rid of. So just to quickly recap the core findings from the report that you need to focus on. While headline CPI looked relatively calm, hovering around 2.7% year over year, the really critical takeaway is that core CPI accelerated, pushing back above 3% annually.
And that analyst calculated supercore measure, the one the Fed watches so closely for domestic demand pressures, it surged by nearly 0.5% just in July, which annualizes to something like 6%. That divergence, that's the absolute heart of the report's warning. It raises the question, doesn't it? How long is it actually going to take to get inflation truly back under control when you have these new pressures emerging, just as some of the old ones are finally starting to fade? It's a really dynamic and challenging environment.
Okay, so let's talk about how the markets reacted right away. The morning the report came out, August 12th, we saw a really decisive positive reaction in U.S. stock markets. You probably saw the headlines flashing green. Major indices surged right at the opening bell. The Dow Jones climbed over 1%, the S&P 500 gained around 0.7%, and the tech-heavy NASDAQ 100 was also up, notably in morning trading. Now, this rally, as the report points out pretty clearly, it was really based on a selective reading of the data, maybe even an overly optimistic one. Traders seem to focus almost entirely on those headline figures, seeing them as basically a green light for the Federal Reserve to go ahead and cut interest rates at their September meeting. The fact that the monthly headline number was okay and the annual rate was a tiny bit cooler than expected, that was enough to spark this big risk-on move.
Yeah, but that initial burst of euphoria in the stock market, it wasn't exactly universal, and the report argues it was built on a pretty fragile foundation. Some market commentary was actually more cautious, calling the move maybe muted given the underlying details, and warning that the mixed signals in the report, especially that hotter core reading, could lead to additional churn later on. This initial celebration was really a classic example of that dynamic we sometimes see. Bad news for inflation hawks is good news for stocks. It kind of revealed a market that's just deeply conditioned to react positively to any signal, however small, that could possibly be interpreted as dovish by the Fed. Lower borrowing costs seem to be the only thing that matters sometimes.
So what stands out to you about this kind of market behavior?
Well, it's a market that, at least in that first reaction, basically ignored the more worrying details lurking in those core and supercore numbers, and that suggests the rally might be pretty vulnerable to a sharp pullback if or when the Fed actually has to acknowledge the stickier parts of inflation in its official statement. It felt more like a speculative move, rather than one grounded in a really deep understanding of what the full report was saying. Hashtag take 2.2, the bond market's nuanced message.
Right. And in really stark contrast to that sort of initial cheerleading in the stock market, the reaction over in the U.S. Treasury market was much more nuanced and maybe ultimately more telling about what sophisticated investors were thinking. It sent this really bifurcated signal. The short end of the yield curve and the long end were telling two completely different stories. So the yield on the 2-year Treasury note, which is super sensitive to what the market thinks the Fed will do in the near term, like with the federal funds rate, that yield fell pretty decisively right after the CPI report came out. Dropped about 4 basis points. That was a direct reflection of the market pricing in a much higher chance of a September rate cut, a clear signal. The market thinks the Fed's about to ease up. Okay, but then you look at the other side, the yield on the benchmark 10-year Treasury note. Now, this one reflects much longer-term expectations about growth and inflation. And in total contrast to the 2-year, the 10-year yield was way more resilient. It basically traded flat, maybe ticked up slightly, hovering around that 4.26% to 4.30% range. This refusal of the long end to rally along with the short end, that was a really significant signal. You really need to pay attention to that divergence.
Absolutely. That divergence between the 2-year and the 10-year yield, what traders call a yield curve flattener, was arguably the most sophisticated and I think the most important interpretation of the CPI data by market participants. The bond market was essentially signaling belief in two conflicting things at the same time. First, yeah, maybe the Fed will deliver that dovish insurance cut in September, perhaps because they're worried about the labor market weakening. But crucially, the bond market was also saying it believes inflation is going to remain a persistent problem over the longer term. And that's what kept those longer-dated yields anchored, or even slightly higher. It was basically looking right past the nice-looking headline CPI number and focusing squarely on that hot 3.1% core reading and the nearly 0.5% jump in supercore. Bond investors saw those figures as clear signs of sticky inflation that would either force the Fed to keep policy higher for longer than maybe the stock market expects, or would simply eat away at the real return you get from holding long-duration bonds over the next 10 years.
If we connect this to the bigger picture, it was a powerful non-confirmation of the stock market's simpler, yay, rate cuts are coming, celebration. It really suggests the smart money on Wall Street, the folks deep in the bond market trenches, they have a much more cautious long-term view. They're bracing for an environment where inflation doesn't just quietly fade away.
Okay, so maybe the most direct, most quantifiable market impact of this July CPI report was just how dramatically it shifted expectations about what the Federal Reserve will do next. Before the report came out, the odds of a standard 25 basis point interest rate cut at the Fed's meeting in mid-September, well, they were already pretty high. The CME FedWatch tool had them around, say, 86, 88%. But right after the report dropped, those probabilities absolutely surged. They jumped up to between 93% and 95%, almost a certainty in the market's eyes. And this sharp increase in conviction, that was really the primary driver behind the stock market rally and the drop in short-term treasury yields we just talked about. So given this really aggressive market pricing now, does it feel like the Fed's hands are effectively tied? Or did they still have some room to push back against this expectation of a September cut?
That's the million-dollar question, isn't it? This market repricing has definitely created a significant gap between what investors are expecting and the Fed's own stated approach of being data-dependent. While the market is now pricing in that September cut as almost a done deal, the inflation data itself, particularly that accelerating core and the spiking supercore, makes it incredibly difficult for the Fed to justify such a move based purely on their price stability mandate. So this really sets the stage for what's going to be a very high-stakes FOMC meeting in September. The Fed is now caught in a real bind. They either have to validate the market's aggressive dovish expectations, which risks undermining their credibility as inflation fighters, or they have to defy the market by holding rates steady, which could easily trigger significant market volatility. The market's logic, as the report kind of lays out, seems pretty linear. Okay, headline inflation looks contained, the labor market softening a bit, therefore the Fed will give us an insurance cut. Simple enough. But the Fed has that dual mandate, right? Maximum employment and price stability.
And this core inflation data directly conflicts with the price stability goal. So yeah, it puts the central bank in a really severe communication and policy bind. And that means, for you listening, there's a high potential for increased market volatility in the coming months as everyone tries to figure this out. So just to quickly recap that market reaction picture, major stock indices like the S&P 500, NASDAQ 100, and Dow Jones all saw pretty big gains right after the report. The 2-year Treasury yield dropped noticeably, reflecting those rate cut bets. But the 10-year Treasury yield stayed remarkably stable, barely budging, showing long-term inflation concerns. And the CME FedWatch tool, it showed the probability of that September rate cut surging to near certainty in the eyes of the market. Really mixed set of signals overall.
Okay, so this latest CPI report, especially when you put it together with some of the recent, slightly softer labor market data we've been getting, it's bringing a word back into the economic conversation that, frankly, nobody really wants to hear. That word is stagflation. It's that really toxic combination, right? Characterized by slowing or even stagnant economic growth happening at the same time as persistently high inflation. It's pretty much the worst-case scenario for policymakers and investors alike.
Unfortunately, yeah, the latest data really does put the different components of that toxic mix clearly into view. Let's take the inflation component first, the aflation part. That seems pretty firmly established now. We've seen core CPI accelerate back above 3% year over year. We saw that sharp spike in the monthly supercore inflation, nearly 0.5%. and just the general stickiness we're seeing in services prices overall. All of that points to an inflation problem that's actually becoming more entrenched, not less. It signals that these price pressures are proving much harder to shake off than people thought, putting us squarely in an environment where inflation persists. Okay, so that's the inflation part. Then simultaneously, the stagnation component, the stag part, that's also becoming increasingly evident. Recent labor market data has definitely painted a picture of a clear cooling trend. We've had weaker than expected job growth numbers. We've seen upward revisions to unemployment claims. It all suggests that the really strong economic momentum we had during the recovery is, in fact, waning. Now, when you put those two things together, persistent inflation and slowing growth, it creates a really severe policy dilemma for the Federal Reserve. Think about it. There are traditional tools for fighting inflation, like raising interest rates. Well, that would likely just make the economic slowdown worse. But conversely, the tools they'd normally use to fight stagnation, like cutting interest rates, well, doing that risks pouring fuel on the inflationary fire that's already burning hotter than they want. It's a real catch-22. In this kind of environment, stagflation, it fundamentally messes up the traditional investment playbooks, like the one that relies on stocks and bonds moving in opposite directions. In a stagflationary world, both asset classes can suffer at the same time. High inflation hurts bonds, slowing growth hurts stocks. So your standard diversification might not protect you like you expect. Economists from Bank of America actually noted, in a stagflationary environment, it is dangerous to cut rates without clear evidence that inflation has peaked. That really highlights how unreliable the so-called Fed put might be right now. You know, that old idea that the Fed will always step in to save markets.
Maybe not this time. So for you, the primary long-term risk that seems to be emerging from all this data isn't just a simple recession or just a period of high inflation. It's this much more challenging hybrid scenario, stagflation, which really requires a different way of thinking about your financial strategy.
Okay, so beyond those broader dynamics of demand and services inflation, the July CPI data give us something pretty specific and also concerning. It seems to be the first clear, concrete evidence that those sweeping tariffs, the ones implemented back in the spring of 2025, are actually starting to show up in consumer prices. Economists and business leaders had been warning about this possibility for months, and now it looks like it's happening in the numbers. We saw the specific examples we mentioned earlier, right? The increases in household furnishings, used cars, apparel. Analysts widely interpreted those as the leading edge of this new inflationary force coming from tariffs. It really suggests that companies, which maybe had been absorbing those extra costs themselves for a while, are now starting to pass them on.
Exactly. And this probably isn't just a temporary blip either. For months, a lot of U.S. businesses were likely bearing the brunt of these tariffs, taking a hit on their profit margins or maybe running down their existing inventories. The July data strongly suggests that their capacity to keep absorbing those costs is now pretty much exhausted. It's like they've reached a point where they simply have to pass these higher costs onto you, the consumer, to protect their own viability. And there's some serious academic analysis that backs this up too. Research from the Yale Budget Lab, for instance, they try to quantify the long-term impact of these 2025 tariffs. Their estimates suggest these tariffs will persistently raise the overall consumer price level by over 1%, and importantly, they also expect it to reduce long-run U.S. GDP. Their model even projects some pretty dramatic and lasting price increases in specific categories over the long haul, things like shoes, apparel, even motor vehicles seeing significant long-run price hikes due to tariffs. So what this indicates is that tariffs aren't just a one-time price level shock that the economy can sort of digest and move on from. Instead, they're shaping up to be a persistent, kind of rolling source of cost-push inflation. It's an ongoing headwind. And this inflationary headwind will likely keep core goods inflation, which had actually been helping bring overall inflation down. It'll likely keep it elevated for the rest of 2025 and well into 2026. This dynamic acts as a direct counterforce to what the Federal Reserve is trying to achieve by cooling demand. It just makes getting back to that 2% target significantly harder.
So, the bottom line from this: prepare for higher prices on certain goods for the foreseeable future as these tariffs continue working their way through the supply chain.
That seems to be the message, yes.
Okay, so beyond the immediate things driving prices like strong services demand and these new tariffs filtering through, there's also this growing body of evidence that suggests something potentially deeper, more fundamental might be going on. The idea is that the underlying nature of inflation itself, the way it behaves, might have actually changed in this post-pandemic era. And this raises a really profound question that the Fed, and frankly all of us, are trying to grapple with now. Is the Federal Reserve fighting a fundamentally different, maybe more stubborn kind of inflation than it has dealt with in decades past?
It's fascinating, isn't it? And how this possibility really reinforces that higher for longer interest rate narrative we keep hearing, and it definitely elevates the long-term risk of stagflation for everyone. Recent research, including some from Federal Reserve economists themselves, has found that inflation persistence seems to have broadly risen after the pandemic.
Huh.
Their analysis looked across major advanced economies, and they estimate that the degree of inflation persistence, basically, the extent to which past inflation influences future inflation, has roughly doubled compared to pre-pandemic levels, from about 0.3 to zero point 0.6 in technical terms. That's a huge jump. It implies that inflation now has significantly more inertia. It's just much harder to slow down once it gets going.
Wow, doubled. So it's much harder to shake off now.
Exactly. And this increased stickiness isn't just showing up in one study. It's actually corroborated by various alternative inflation measures that try to filter out the temporary noise.
Wow.
Things like the Atlanta Fed's sticky price CPI or the New York Fed's multivariate core trend inflation, they all seem to point towards a more persistent underlying trend than what you might see just looking at the headline numbers. And this isn't just a U.S. thing either. International bodies like the IMF and the European Central Bank have also noted that sticky services inflation is making it harder to bring inflation down globally. They expect core inflation to decline much more gradually than headline inflation pretty much everywhere. Now, if inflation has indeed become structurally more persistent, the implications for monetary policy are really profound. It would strongly suggest that a higher degree of monetary tightness, higher interest rates will be needed for a longer period of time to really bring inflation sustainably back down to that 2% target. This directly challenges the whole framework that was kind of built on expecting a quick return to that low inflation, low interest rate world we had in the 2010s. Maybe that era is just over. What could be causing this? Well, one theory is a change in inflation expectations themselves. After living through a prolonged period of high, very visible price increases, maybe firms and households have just become more attuned to inflation. Maybe they now adjust their prices and their wage demands more rapidly in response to past inflation, creating this kind of self-reinforcing cycle. If that's true, it could mean a couple of big things. One, the neutral rate of interest. The rate that neither speeds up nor slows down the economy might just be structurally higher than we used to think. And two, perhaps more unsettlingly, the amount of economic slack, meaning, unfortunately, higher unemployment that might be needed to really break this inflation cycle, could be significantly greater than in the past. This is a really fundamental potential shift that touches every part of our economic outlook.
Okay, so we've painted this picture of a pretty challenging economic backdrop. Slowing growth, sticky inflation, maybe even stagflation risk. What on earth does this mean for how you should think about your money and your investments? Well, this emerging environment we've just laid out, it's uniquely hostile to some traditional ways of building a portfolio. Think about the classic 60-40 stock bond mix. That's been a staple for decades for many investors. It works because stocks and bonds usually have this negative correlation. When one zigs, the other zags, providing a nice cushion. But in a stagflationary environment, that relationship can completely break down. Both asset classes can actually decline at the same time. High inflation hammers the real value of your fixed bond payments, while slowing growth and squeeze company profits weigh heavily on stock prices. It's a double whammy. So the goal really shifts here. It's less about just chasing nominal capital appreciation and much more about preserving and growing your capital in real inflation-adjusted terms. Protecting your purchasing power becomes key.
Exactly. It really does mean thinking differently about how to protect and grow your wealth in what looks like a new regime. You need to seriously consider increasing your exposure to asset classes that have historically shown resilience and maybe even provided a hedge during inflationary periods like this. So what are we talking about? First, real estate. Now, this could be direct ownership of property or through real estate investment trusts, REITs. Why? Because property values and especially rental income streams tend to rise along with inflation over time. It offers a kind of natural buffer against your money losing value. Second, commodities and precious metals. This becomes a really crucial component in this environment. Gold, in particular, has a long history as a reliable store of value, and it's often performed well during stagflationary periods when economic uncertainty is really high. Industrial commodities, like oil or copper, can also benefit from rising prices, but they do carry that extra risk of being sensitive if global economic demand really falls off a cliff. So maybe a bit more caution there. And third, something we've mentioned a few times, inflation-protected securities, or KIPS.
Treasury inflation-protected securities. These are arguably an essential holding in this environment. Why? Because the principal value of TPS is explicitly designed to adjust upward with the consumer price index, gives you a direct contractual hedge against inflation that you just don't get with conventional bonds. It's direct protection for your purchasing power.
Okay, let's talk stocks. This whole regime shift, persistent inflation, higher for longer interest rates, it fundamentally changes the math when you're comparing value stocks versus growth stocks. For the last decade or so, we saw this incredible run where growth investing just absolutely crushed value. But as the report highlights, that period might have been largely an anomaly. It was really fueled by that unusual environment of super low inflation and near zero interest rates. That environment essentially pulled the perceived value of distant future earnings way forward, making growth stocks look incredibly attractive. This current macroeconomic shift feels like what one analyst called a gravitational shift back towards reality, back to an environment where the old-fashioned fundamentals, things like current profitability, strong cash flows, and reasonable valuation become paramount again. So what's the upshot for your stock portfolio in this new world?
All right, let's break that down. First, let's look at growth stocks. By their nature, these are inherently long-duration assets. A huge chunk of their valuation comes from earnings that investors hope they'll generate far off in the future. Now, in a higher interest rate world, the discount rate you use to value those future cash flows goes up. And when the discount rate goes up, it can severely compress those typically high price to earnings, or PE, multiples that growth stocks trade at. The report specifically warns that unprofitable, high-valuation growth stocks are particularly vulnerable right now. Their whole business model often relies on cheap capital and assumptions of massive future growth, both of which are now under serious pressure. Okay, now let's flip to value stocks. This style focuses on companies that usually trade at lower multiples of their current earnings and cash flows. You often find these in more mature, maybe cyclical industries, think energy, materials, industrials, financials. Because their value is based more on near-term cash flows, they have a shorter duration profile. That makes them significantly less sensitive to changes in those discount rates.
Higher rates just don't punish their valuations as severely as they do for growth stocks. Furthermore, many of these value-oriented companies often possess greater pricing power. They might be in industries where they can more easily pass on rising input costs to their customers and protect their profit margins. That's a critical advantage when inflation is high. And if you look historically, value stocks have actually consistently outperformed growth stocks during periods of high and rising inflation. It's a pattern we've seen before.
So what's the bottom line here for your stock portfolio? It seems pretty clear. A strategic overweight towards the value factor and likely a corresponding underweight towards those high valuation, maybe more speculative growth stocks is probably warranted right now. Within your equity holdings, the focus really needs to shift towards finding companies with resilient balance sheets, maybe a history of stable dividend payments, and most importantly, that demonstrated pricing power, the ability to raise their prices without driving away customers. These are the kinds of companies best positioned to navigate this new economic paradigm.
Yeah, digging down into specific sectors in this kind of environment, slowing growth, persistent inflation. Your sector selection needs to become much more nuanced. It's not just a simple buy defensives or buy cyclicals game anymore. The key differentiator for which companies will succeed, as the report really emphasizes, is going to be that pricing power we just talked about. That ability to pass on rising costs without killing demand for your product or service. So, a potential approach to consider is what some call a barbell strategy. You combine a core holding of defensive sectors with some carefully selected resilient cyclical sectors that also have pricing power. Okay, let's break down how that might look in terms of sector positioning. First, your defensive overweights. These are sectors generally characterized by relatively inelastic demand. People need their products or services regardless of the economy. Consumer staples. Think companies making food, beverages, household products. Demand tends to hold up even when budgets get tight, and strong brands often give them pricing power. Healthcare. Demand for healthcare is generally non-discretionary.
People get sick, they need medicine, regardless of the economy. This provides a stable earnings base, plus you have ongoing innovation in this sector. Utilities. This sector often acts a bit like a bond substitute due to its stable, regulated business models. Regulation often allows them to pass through inflationary cost increases to customers. Plus, there are longer-term tailwinds from things like electrification and AI data centers needing more power. Okay, now for the other side of the barbell. Selective cyclical exposure. Because not all cyclical sectors are created equal in this environment. We can think about favorable cyclicals, overweight, energy and materials. These sectors are direct beneficiaries of higher commodity prices, almost by definition. They have inherent pricing power linked to the underlying commodity, industrials. This sector could benefit from longer-term trends like increased government spending on infrastructure, the reshoring of manufacturing back to the U.S., and ongoing strength in areas like aerospace and defense. Then, There are neutral cautious cyclicals. Information technology. This is tricky. Some parts, like cloud computing and essential business software, might act more like staples and show resilience. But the broader sector is dominated by those long-duration growth stocks, making it very vulnerable to valuation compression from higher rates. Financials. Also a mixed bag. Higher interest rates can actually help boost bank profit margins, the difference between lending and deposit rates. But an economic slowdown increases the risk of loan defaults and credit losses. Communication services. This sector is also a mix. You've got more defensive telecom companies alongside highly cyclical media and internet giants that are very exposed to potential slowdowns in advertising spending. And finally, the unfavorable cyclicals, underweight, consumer discretionary. This sector looks the most vulnerable. It includes things like cars, apparel, restaurants, travel, things people cut back on first when money gets tight. These companies often have limited pricing power for non-essential items and are likely to face the most significant hit to demand as inflation erodes real household incomes.
What stands out to you about which sectors might thrive or struggle in this environment? It really comes down to looking at those underlying business characteristics, doesn't it? Especially pricing power and resilience. That seems key to navigating the shifting sands of this economy.
Precisely. It requires a much more granular approach than just broad sector bets.
Okay, let's pivot back to fixed income, to bonds, for our final strategic area. Given everything we've discussed, especially that split reaction in the bond market to the July CPI, right? Short-term yields fell on rate cut hopes, but long-term yields stayed high because of inflation fears. It really underscores just how complex the risks are right now for bond investors. This is definitely not a simple buy bonds environment. So it seems like a cautious, active approach to managing your portfolio's duration, its sensitivity to interest rate changes is absolutely critical.
That's exactly right. It's a tricky landscape for bonds. So thinking about your duration stance, the overall interest rate sensitivity of your bond holdings, a neutral or maybe even slightly underweight stance on overall portfolio duration seems prudent. Why? Because even if the Fed does cut short-term rates a bit, that persistent risk of sticky inflation keeping long-term yields elevated, or maybe even pushing them higher down the road, makes extending way out on the yield curve buying very long-term bonds look pretty unattractive right now. You don't want to be overly exposed if inflation stays problematic. Now, in terms of curve positioning, where on the yield curve should you focus? Well, investors might want to consider concentrating on the middle part of the yield curve, say bonds maturing in 3 to 7 years. That segment often offers a good chunk of the yield you can get further out on the curve, but with considerably less duration risk, less sensitivity to rate hikes. It can be a kind of sweet spot for balancing yield and risk in this climate. And then finally, asset selection within bonds.
As we noted earlier, having a core allocation to those TIPS, Treasury inflation-protected securities, seems essential as a direct hedge against any unexpected upside surprises in inflation. Within the credit space, focusing on high-quality, investment-grade corporate bonds can give you a bit more yield than government debt, but hopefully with manageable credit risk. However, you probably want to be pretty wary of lower-quality high-yield bonds, sometimes called junk bonds. Their higher credit risk makes them particularly vulnerable if the economy slows down significantly and default rates start to rise. That's not where you want to be if stagflation hits.
So this raises an important question then. How do you actually balance that desire for yield with the need to manage risk in your bond portfolio, given this really uncertain outlook?
It requires a very deliberate and thoughtful strategy. No easy answers, unfortunately.
Yeah.
You have to be selective and manage your risks carefully. Hashtag tag tag outro.
So let's try and wrap this all up. What's the big implication here? The July 2025 CPI report wasn't just, another monthly data point. It really felt like a pivotal event, maybe confirming a fundamental shift in the whole macroeconomic regime we're operating in. It seems pretty clear now that the era of just straightforward, maybe even immaculate disinflation is over. It's been replaced by a much more complex, maybe more hazardous environment, one defined by this inherent conflict between slowing economic growth on one side and stubbornly persistent core inflation on the other. The market's initial relief rally after the report. Well, as we've discussed, that looked like a very first-order, maybe even myopic reaction to a somewhat misleading headline number. Meanwhile, those more sophisticated signals coming from the bond market, the diverging yields, and especially that sharp spike we saw in supercore services inflation, they point directly to the real underlying challenges that still lie ahead. The Federal Reserve now finds itself in an exceptionally difficult position. They're caught between the competing demands of their dual mandate, trying to support employment while also fighting inflation. With the market now aggressively pricing in a September rate cut that the core inflation data itself really struggles to justify, the path forward for monetary policy is just fraught with uncertainty, and that virtually guarantees heightened market volatility in the coming months. So, for you, the listener, this new paradigm really demands a strategic recalibration of your financial thinking. The playbooks that worked so well over the past decade, when low inflation and low rates fueled aggressive growth investments, well, they're just no longer sufficient. The key strategic imperatives for investors seem pretty clear and urgent now. First, embrace inflation resilience. You need to fortify your portfolios against the erosive power of persistent inflation. That likely requires a meaningful shift towards real assets, things like real estate, commodities, and also explicit hedging tools like tips and maybe gold. Second, favor value over growth. The era of cheap money that fueled that historic run in growth stocks appears to be over. In this new world of higher inflation and higher interest rates, investment success is likely going to be dictated more by fundamentals. So, a focus on companies with strong current cash flows, robust pricing power, and reasonable valuations becomes essential. And third, prioritize pricing power and balance sheet strength. When you're selecting sectors and specific stocks, you need to look beyond simple cyclical versus defensive labels. The critical differentiator will be a company's ability to protect its profit margins by effectively passing on rising costs. That's a direct function of its competitive position and the nature of its products or services. What stands out to you as the biggest takeaway from this deep dive? For me, it's just crystal clear that the playbooks of the past decade are no longer sufficient for the challenges ahead.
Yeah, and looking at the broader context, the evolution of this two-track economy, this whole story, is really going to be determined by the next few key data releases. The upcoming August jobs report that'll give us a much clearer picture of how the labor market is holding up. And, of course, the August CPI report itself. Those two reports are going to be dispositive. They will ultimately determine whether the Federal Reserve feels forced to validate the market's aggressive rate cut expectations, or if they feel they have to defy them at that pivotal September meeting. So the obvious question then becomes, how will these next few reports shape this economic landscape we've just spent time discussing? And maybe more importantly, how will you position yourself to navigate whatever comes next? Navigating this kind of landscape successfully will absolutely require discipline, a sharp focus on achieving real inflation-adjusted returns, and an unwavering commitment to quality in all your financial decisions. It's a time for careful consideration.